Stocks resume the sell-off, breaking below the trading range, breaching a critical level of support, and possibly opening the door to another big move down. This is technical analysis of the stock market's update and forecast for the week starting September 21st, 2020. Hello traders, I'm Richard Graham. We're going to start by taking a look at the S&P 500. This is the 1 hour chart, and as you can see, we were in this bullish channel for quite a while, several weeks, and we finally broke above this February all-time highs back on August 24th, and then we kind of went parabolic all the way to the top of the channel, and as soon as we hit the top of the channel, we sold off hard to the bottom of the channel, paused a little bit, came down and retested that level once again before coming down and forming the bottom of a new channel where I've cloned this trend line. As you can see, we came up and we retested this area where we had some support and it became resistance, came down, retested this level for a double bottom, and then on September 16th or so, we came up and retested that level once again, and we just couldn't get through it. So we tried once, we tried twice, and then we came down to the bottom of that channel, and after trying 3 times to get down through it, we did on Friday. This is a critical level of support that has been breached because we've been in this trading range ever since the 4th of September. So for about 2 weeks, we've been in this trading range, and now we've broken down to the downside. And we came down, and we hit the bottom of the next lower channel that I drew in here. And so Friday afternoon, we came up and retested that level as resistance. This was an opportunity that a lot of people thought would be a good time to take a short position. And the reason why is because we have a lot of room below in which to fall. The next major level of support is right at 3,200. Zooming out to the daily chart, we can take a look at that level of 3,200, and you see that the first time that we hit it, after we had the February and March sell-offs, was we came up and we hit this level on June 8th. And it was an island reversal pattern, sold off hard, came back and retested it several times, broke through it, came back and retested it as support, and so now we could be coming back down to that level. The first level of support could be right here where we fill this gap right around 3270, but this major level of 3200, markets love round numbers, is something I'm really going to be keeping my eye on. This could be an opportunity to possibly get long and see if we can't get a bounce back up to this previous line of support, which would act as resistance. So trade from here to here. So if price does get down to that level, I'd like to see if we're going to get some kind of bounce and get some higher highs and higher lows on the smaller time frames and possibly ride it up to this area here. If it blows through that level, the next level of support we have is that nice round number of 3,000. Now, there's a tool that I like to use to forecast and project future price levels, especially for support and resistance. I like to use this trend-based Fibonacci extension tool. So if we take it from the very highs here, right before the sell-off, and then we take it down to where we bounced from, and then we bring it up to this swing high, then we can kind of see where we might have some projection in the future. If we sell off all the way to the 3,000, that just happens to exactly coincide with the 1.618 Fibonacci extension of the initial move, which is considered the golden ratio. And it lines up exactly with that number. So that's another number of support that you really want to keep your eye on. We could be coming down to 3,000 as well. But before we do that, we have to get through that 3,200 level. Now, the momentum is definitely to the downside. So for the bulls to have a case, they need to get through all of this damage on the downside. They got a lot of resistance. We've got this trend line here in red. We've got this trend line here in white. And we've got this trend line right here that now I'm going to change to red. And I'm also going to change this trend line right here to red as well. So now we've got a lot of resistance. What was support is now resistance. I'm not going to be comfortable getting long this market again until we start seeing some higher highs and higher lows on the smaller term time frame. This is a critical area of resistance that we're going to have to get through right around the 34.25 level. Until then, I'm going to be bearish on this market until we start to see a turnaround on the shorter term time frames. we have now closed, for the first time since April, below the 50-day moving average on the S&P 500. Here's the triple Qs. This is the ETF fund for the Nasdaq. And as you could see in my previous video, I drew in this line of support where I was saying that if we breached it, we'd probably come down and come to the next level of support right around 250. And it looks like here on Friday, we have breached it to the downside, closed down below it. So I would expect this. It's more likely than not that we're going to come down to this next level of support, probably right around 250. At that point, we could see a bounce, come back and retest these levels of previous support as resistance, and that might be an opportunity to get short. At that point, we're just going to have to drill down to the lower time frames and see if the trend is starting to turn around to the downside. Here's the IWM. This is the ETF fund for the small cap stocks, the Russell 2000, and this is the one spot of a little bit of good news, I guess you could say. Here's the initial sell-off, and we retraced a lot more than we did on the other indexes in the stock market, so the small caps are holding up actually better than the Nasdaq. We haven't broken down on the Dow yet, below its support line, still holding up. So it looks like the S&P 500 and the Nasdaq are the leaders to the downside. After all, the major cap-weighted stocks are what drives this market. And here's Apple, part of Nasdaq, part of the S&P. It's a huge percentage of the market share in those indexes. And as you can see, here on Apple, we've broken below support. And if we get a measured move, similar to the one we just had from the highs, that could bring us all the way down to the next level of support right here around 94. Amazon is another one that broke the major upward sloping trend line right here on September 4th, came back and retested that area, and then it's been selling off ever since. One thing that's interesting about Amazon is that we are sitting at this level just above previous support. So even though we've had this big sell-off, we could bounce from here. However, the chart is still definitely bearish on the short-term time frame. Here we are on the 1 hour chart. Personally, I wouldn't get long Amazon until we start to see a repair of some of this bearish momentum on the short-term time frame. Back out to the daily chart. If this area is breached, the next level will bring us right down to this area at about 2780. Here's Microsoft, another major cap-weighted stock. And as you can see, we broke through this major upward trend a few days ago, came back and retested it, and then we were sitting at this level of support here. In my previous video, I said if we broke down below this level, we could come down to this major level of support right around 190. It's still in the cards. Here's Google. It's another major cap-weighted stock that has been on a bearish momentum lately. If we take this trend line right here, we can see that we do have some support right here. And that's exactly where price is resting right now. We could come back and retest this level, but remember, just like the other stocks, the momentum is to the downside at this time. Here's Facebook. In my last video, price was still holding up above the upward sloping trend line, but it broke down on Thursday, and now it's still got bearish momentum. If we break this area, we'll probably sell off to the next level of right around 220. Tesla is not a major cap-weighted stock, not yet, but a lot of people have their eye on it, and it's one of the most bullish charts out there right now. In fact, while everyone else seems to be breaking below their upward sloping channels, Tesla seems to be holding up. Here's Bitcoin. For a while here on the daily chart, we were stuck in this trading range, and then we broke down below it. Looks like we're coming up for a retest of that major area of what was support to act as resistance. Like I said in my last video, I wouldn't be bullish Bitcoin until we can get back above this key level of right around 11,400. Come back for a retest, and then see if we can get a resumption from there. Otherwise, this could act as a key level of resistance, and we could see a lot of traders step in and try to sell from there all the way down to the next level of support right around 9,500. Here's TLT. This is long-term government bonds. In my last video, I said which way it breaks is probably going to be opposite of the stocks. We still haven't broke out of this triangle pattern. Holding steady, keep your eye on bonds. Here's gold on the daily chart. We've been in this bull trend for quite a while now, since 2018. And now we've been in this consolidation pattern since August. Generally, these bull flag patterns do break to the upside, and so we might get an equal move, say up to right around the 2100 level. However, if it breaks down, we do have support right around 1800. Here's silver. This is SLV, the ETF fund for silver. And as you can see, it's very similar to gold. It is a bull flag. However, the momentum seems to be slowing down the last few days. If we break this triangle to the downside, the first level of support is going to be right around 23. Otherwise, we have resistance at 27. The VIX is the fear index, and look how much fear came into the market back in February and March when the VIX reached 85. And we came down into this declining wedge pattern, and then the island reversal in June, a lot of fear came in, same thing. And then we had this situation where we were breaking out to the upside. The trend was reversing. We had higher highs and higher lows, and then we had the sell-off in early September. And then we've come back and hit this area of support. Now, if the market continues to sell off, the VIX will spike up, probably into the 40s or 50s. Under normal bullish conditions, we usually see the VIX somewhere between 10 and 15. Anytime it's above 20, it's time to be cautious. Here's DXY. This is the ETF fund for the dollar. As you can see back here in March, we really spiked to the upside when we had that sell-off. If we have a sell-off in the market, we're probably going to see another spike to the upside in the dollar. We could see a volatile week of trading. A lot of big stuff on the economic calendar. Monday, Fed Chairman Jerome Powell speaks, and then he testifies on Tuesday, along with existing home sales. Wednesday, we got the crude oil inventories. And then on Thursday, it's initial jobless claims and the new home sales. And then coming out on Friday, we have the core durable goods orders. All right, guys, so that's the picture. The momentum has resumed to the downside, and we have quite a bit of room that we could fall. 3,200 and 3,000 are the major levels of support to keep your eye on. If you like these kind of videos, make sure you hit the like button and subscribe if you haven't already. That way you won't miss my next video. All right, guys, have fun trading this week, and we'll see you next time.